Welcome to the OR Talks podcast. Here are your hosts, Neil Seeger
and Marc Jovanovic.
So Marc, another podcast in 2026.
Second one already.
Second one, they're flying by, these are.
Yeah, it is flying.
It literally is flying by. We'll have episode 12 before we know, honestly. So today we're going to be starting off with Marc's Myth of the Month.
Yeah, back again.
So Marc, you've been looking around, you've had many people contact asking you different questions, and what is the myth of this month?
So people are messaging about this as well, and I've actually seen it on TikTok and Instagram myself.
Yeah.
People saying salary is better than dividends. Take everything out of the company, it's a salary. Which can be true, but it's not always true. The problem with these videos is they give a very, very short bit of advice, really catchy, really confident, but it doesn't give enough context as to whether it is for everyone or not.
So is it always better to have a small salary, say 12,500, which is the one that's bounded around everywhere, or a salary is the one that I saw, a salary of 12,570 to be precise, and then having the rest of my income of dividends?
It can be. And that is, in most cases, that can be the most tax efficient way of doing things.
Okay.
Because the salary of 12,500 roughly, that gives you, as an individual, a qualifying year for national insurance towards state benefits, so your state pension.
Yeah.
The company is getting the tax relief on that 12,500 as a salary.
So you save your corporation tax?
Yeah. And then dividend tax, as you as an individual, is lower than what it is for employment income, so salary. Salary starts at 20%. Dividends start at 8.75%.
Yeah, so soon from the 6th of April it's worth pointing out to be 10.75.
Yeah, you beat me to it.
Yeah, I know. I do have to get in there or something somewhere.
This is why you have the knowledge course.
Yeah, absolutely. Yeah, I need to get back in my corner, don't I? This is your moment, sorry.
Yeah. So that is something that's shouted about on TikTok. It's really good, it grabs headlines, but it's not always the case that salary is better. Obviously, the bigger the salary, the more corporation tax relief you're getting in the company, but there are drawbacks to that, aren't there now?
Yeah, there are. And so, I'm just going to, one of the things, is there a tipping point where it is more beneficial? Is there
it used to be really, really clear. So once you're sort of over 150,000, it used to be, but it's a lot more closer now because dividend tax has gone up. National insurance for employers has gone up as well.
Yeah.
So it's a lot more balanced now. There's a lot more things to factor in, really.
So it's always worth. So it's always worth actually running the numbers side by side. Yeah. So if you, I mean, as a general, the general classic that we see is people cap themselves at 50,000. They don't go to the 40% bracket, as people call it. And at that moment in time, you probably are more beneficial being salary and divs.
Yeah.
If you're going to go above that, then it probably is worth exploring the cases side by side for what it is. So if you're an owner-managed company, so it's so if a husband and wife or two partners owning a limited company, then potentially you're going to be better off both at 50,000.
Yeah.
But if you're so it's just me and I'm just a shareholder in your business, then I'm 100% going to want it to be salary and dividends, aren't I? Because I'm not too concerned with the company saving.
Exactly, that's it, yeah. And the other thing is, when you're looking at whether to take salary and dividends or just salary, if you're the only director, the company then can't claim employment allowance if you've got no other employees. So they're going to have to pay the national employer's national insurance in full.
So that headline that you see pushed around everywhere, that you can have £10,000 worth of employer's national insurance and not pay a penny over to HMRC, which is called your employment allowance. Yeah. That doesn't count if you're a sole director.
Yeah, and you've got no other employees.
No other employees. So it's just me, just in my consultancy company, let's just say.
Yeah.
Then I can't claim that.
Exactly. And that gets missed by a lot of people. The headlines there, like you say, £10,000 tax free.
Yeah, because I've got a lot of clients contact me saying I can claim £10,000 tax free from the government. Well, you can, but not as a single limited company director.
That's why not one scenario fits everybody. Everybody's situation is different, cases are different. That's why you always have to look at the individual. So just because your mate in the pub does it one way doesn't mean it's going to work for you as well.
So I suppose on that one actually, quite a common example is I've got my own consultancy business.
Yeah.
My wife works elsewhere.
Yeah.
I take my salary and dividends, cap myself at the 50,000. All absolutely great, paying them a small amount of tax. Obviously, I pay over. I think it's around about sort of about 1,100 quid you end up paying on a 12,760 salary. You end up paying about 1,100 quid I think to HMRC, something like that. but you can't claim employment allowance.
Yeah.
But if I'm paying my wife at the company anyway, and I'm just paying her as maybe as self-employed, it might be worth considering put her on the payroll, or husband or wife, whichever, put them onto the payroll, and then because there's two of us,
you can then claim the employment allowance.
The fact I'm a director and she's not, or he's not, is irrelevant. It's that they're an employee on the payroll.
That's it, yeah. Spot on.
So it's worth exploring, actually. If you're the only person on there and your partner's, earning maybe elsewhere, it might be exploring to add them onto the payroll.
It is, because overall it could give you a good tax saving there, because you're not having to pay any national insurance at all.
Particularly if they're working for the business already.
Yeah.
It's or actually how often do we see it where actually people are working in the business and not paid because it's not deemed tax efficient. It might actually be tax efficient to do so.
Yeah. Always worth looking at and asking the question to us, really.
On that case by case basis. Yeah. Case by case. On our last podcast, we mentioned about MTD.
Yeah.
So people going self-employed, people that are self-employed earning more than 50,000. Now don't worry, I'm not going to go over it all again. You've listened to that before. But the one thing that we didn't mention, which is going to catch quite a lot of people out, is you have to register to be MTD.
Yeah, that's right, yeah. So although you're over the threshold, you're not automatically registered in for MTD, you still have to physically register with HMRC.
So HMRC already know that I'm over 50,000 in 24-25. They've sent me a letter saying that I've got to start filing quarterly.
Yeah.
And even after all that, I still have to register.
Yeah, you have to sign up and say you're in MTD, basically. It's on you to do that.
And they won't just automatically sign me up?
Unfortunately not, no.
Even though they told me those two things. Okay, fine. So if you are in that position and you're not already registered for MTD, please make sure you do before the 6th of April. That everyone's got to be registered by the 6th of April.
Yeah, and if you're unsure, just get in touch and we'll help you out with it.
Absolutely, yeah. But it's something I hadn't seen that wasn't mentioned any other things. I actually thought it was June you had to sign up by, which is your first submission.
Yeah,
but it's not.
Very easy to overlook it because you think because you're caught by it, you're going to be automatically
enrolled. Yeah. But actually, weirdly, you don't get a choice, but you have to sign yourself up.
Exactly.
Well, there we go. Make sure you don't miss that. Make sure you don't miss it. If you're not, as Mark said, please contact us. So that's the MTD. So I don't think I'm going to mention MTD now for the rest of the podcast.
You're going to promise to that?
Well, we'll give it a couple of minutes and we'll see if we change our mind.
So, moving on to then, my favourite part, Neil's knowledge.
So Neil's knowledge. So what have we? So Neil's knowledge this time. I thought it was a good time coming to the tax year, looking at all the things that people miss. So we mentioned one of them already. So I stole Mark Smith. And actually stole one of my knowledge ones, and one of them is the employment allowance.
Yeah.
Now, we've already gone through that one, but that is something that if you're not claiming it, or you'd like to look to claim it, please ask and don't miss it, because it is payments it is amounts that are paid to HMRC that could be avoided with a bit of careful planning.
Yeah, and if you are claiming it and you're actually unsure now whether you should be, again, get in touch and we can help you sort.
Well, it's the flip side actually. People do claim it as single directors, and they shouldn't be.
Exactly.
But it's worth noting that you only get one of those per group of companies.
Yeah.
So if you've got 5 companies, you only get one employee.
Yeah,
you don't get multiple. So that's something that's worth bearing in mind.
Yeah, so it can easily be claimed by mistake, can't it?
Absolutely. So linking in with payroll, the other thing that people, I've had quite a few clients recently where they're just taking purely dividends.
Yeah. No
salary, because it's cheaper. Now, to a point, they are right. The rate of tax is cheaper having it as a dividend.
Yeah.
But you're wasting, as Mark said earlier, you save your tax on the basic rate salary. So anything below 12.5 grand, you pay no tax on it personally, and the company will save corporation tax.
Yeah.
So they're missing that saving, but that's a key thing and also they're missing their contribution to their state pension.
Yeah.
The national insurance qualifying year, I think you called it earlier, Mark. They're missing that.
Yeah.
So actually, it's a double whammy, really. You're not getting your state pension contribution, and you're not saving tax on it if you're taking dividends.
Yeah.
So it's worth putting that in. If you're not claiming, if you're having an income, if you've got a limited company and you're working for it, even if you've got employment elsewhere, it might be worth exploring whether to take some of it as a salary.
Yeah, and it can come in helpful when you're going for things like mortgages. Sometimes they like to see salaries going through as well as just dividends.
You get your pay slips, haven't you?
Yes, that's it. So it can help you in other ways as well.
And it's looking at it as a tax neutral for a limited, between there or thereabouts, tax neutral between a limited company paying you a salary and the tax you pay on it.
Yeah.
If you're talking less than 50,000, then you're not. But it's worth looking at side by side. Actually, I'm taking all my income dividends. Is it worth me taking any of my income salary? That's always something worth noting.
And it's worth doing it this time of year. We're coming to the end of the one tax year.
Yes.
Next tax year is going to start next month. Get anything new in place from then makes it nice and clean and tidy.
Another thing that's missed is mileage.
Yeah.
The amount of people that I see, talk to, it's even out on TikToks where people use their own vehicle, so it's not always a car, sometimes it's just a vehicle that they use for their business, which was a hobby that's now become more of a business. So let's just say a photographer, so a wedding photographer who's going out every weekend, more for their hobby. They have their Monday to Friday job, and they're self-employed as a photographer, declaring their income in a limited company, or whether it be as a sole trader, whichever. So they're out there driving their car around, they declare their income, they put their cameras through, and that's in reality their main costs. They miss mileage. So if you've been using your car or your vehicle for work or for your business, make sure you look at mileage.
Yeah, because you can claim 45p a mile, can't you, for your first 10,000 miles?
For your first 10,000.
And then after that, it drops down to 25p a mile.
Absolutely, so it's really, really, really worth it. And actually, that is a reimbursement to you, so you pay no tax on that, and it saves the company or the business tax. So it's definitely worth exploring that if you're not already putting that in. Pensions is always a big one that people miss. They will put it out of their personal, I think we mentioned this in the last one as well, but they put it out of their personal bank account into their pension when they've got a limited company. So they take their money out of the limited company, pay dividend tax on it, sometimes at 33.75, soon to be 35.75%, and then put it into their pension. It's not tax efficient, that, Mark, is it?
It'd be a lot better for you to put it straight into the pension from the company. The company will get tax relief on it, and you're not having to pay that personal tax bit in between. You're just skipping that bit, really.
So you put in your pension contribution, say 10,000.
Yeah.
£10,000 comes out of the company, but you're paying the 3,500 at the higher rates of tax on that. So you've only got £6,500 left in reality after tax to put into your pension.
Yeah.
Yes, okay, HMRC top that up, but you're still out of pocket.
Yeah.
Because they only top it up by 20%.
Exactly, yeah.
Whereas if you took out your company, you'd have the full £10,000 going in, and you'd save your corporation tax.
Yeah.
So it actually only costs you 7.5.
Exactly.
The higher rates of corporation tax.
Yeah. So it's worth looking at which way is better for you, but yeah, pension contributions from your limited company are a really good thing to look at.
Do get missed a lot.
Yeah.
Now the other thing that people do for their own businesses is they work from home.
Yeah.
So HMRC allow you to put in, so have a cost in your limited company or your self-employment for doing your accounts, your booking your appointments, all those sort of things, running your business from home.
Yeah, a lot of people use their home as their office, don't they? Especially in the early days of setting up a company.
Yeah. So therefore, you can have an allowance towards, or effectively, I mean, people see it as renting that space back to their limited company.
Yeah.
But again, it's a reimbursement, so you don't pay tax on it personally as long as you're using the flat rates of HMRC. You'll save corporation tax on that and pay nothing yourself.
Yeah, it's another good one that people do overlook.
Always miss those things. The other thing that people miss is, I think we mentioned this on previous ones, I think we might have mentioned the one before Christmas or the end of December, which is trivial benefits. So this is, as a limited company director, so it's me and Mark in a partnership together in a limited company. We could have 300,000, I wish, 300,000
that would be
£300,000, how should I say that generous? £300 each of basically, let's just say for the sake of argument, non-cash or equivalent vouchers.
Yeah. Okay.
So the easiest way to describe this is we can have up to £50 vouchers each. So we can have six £50 vouchers for a year out the limited company to us each and pay no tax on them.
Yeah.
So it's always worth, if you're not doing it already, start doing it.
Yeah. So loads of people completely miss that, but it's a really good little tax saving for you. You're going to spend that money anyway on something.
Absolutely.
Just do it in a more efficient way.
Absolutely, make sure. And if you've got any questions on it, then just ask. But you can't suddenly take a £300 voucher and do it that way because that's not part of it. Yeah. It's £50 maximum per transaction.
That's good. I like Neil's knowledge.
That's the knowledge section we got. So that's all I've got from a knowledge point of view for this time, without trying to confuse anybody. But for the end of the tax year, these are the things that are really important to make sure you use, or if you're not using them already, start using them. And if you are doing them and you're not sure, just ask. We've recently had the spring budget.
We have, yeah.
Which is probably worth pointing out. But
there wasn't a lot in it from a sort of tax point of view at all, was there? But basically just confirmed everything she'd previously said is going to come into force.
So namely your dividends, like we mentioned, they're going up by 2%.
Yeah, from 6th of April.
So your new dividend rates are from 8.75 and now 10.75.
Yeah.
And the higher ones have gone from 33.75 to 35.75. But the additional rate one hasn't changed.
No, that hasn't changed, no.
Okay, so that's still as it was.
So yeah, taking dividends is going to become a little bit more expensive because of that.
Which also then links into what we were saying earlier about make sure you get your planning in and make sure you look at the numbers side by side,
yeah.
salary versus dividends. But nothing else actually changed in there, did that?
No.
For the current tax year, for
yeah.
26, 27.
Yeah, the tax year we're going into, there was nothing new that we didn't already know about really.
That's good news.
Yeah, keeps life simple.
Absolutely. Well, the tax hasn't come down, so
no.
But we can hope for next time. But that's everything from me. Anything else from you, Mark?
I don't think so, no.
Well, thank you for listening.
Yeah, until next time, thanks very much.
Absolutely, thank you.
If you do have any questions and you want to get in touch, just drop us a WhatsApp on 01905 777 600.
I thought you were going to try and get me with a number then. I was waiting.
I thought about trying to trip you up with it.
Thanks for listening.
Cheers, bye.